So recent changes to Social Security involving the Windfall Elimination Provision causing Social Security checks for a lot of retired teachers, or a lot of retired police officers, firefighters, other folks that were working for the public government for many of their years, seeing their Social Security check go up. So we're going to talk about that on the program. Plus, as of the original air date of the program, there are 2 days left before the end of tax season. Of course, not the official end of tax season, because here in Florida, because of the hurricanes, they actually extended it to May 1. But that is not a universal extension if you have any state returns. So we're sticking with that sort of April 15th deadline, if you will. But an important tax issue that keeps coming up every tax season. Frankly, this past season at the office at Nelson Financial Planning, we saw it in much greater amounts than perhaps what we've seen. So we thought we would spend a little bit of time talking about it. It has to deal with a little bit of Social Security. So if that's the case, then we invited in fellow certified financial fiduciary at Nelson Financial Planning, who also is our resident Social Security expert, a national Social Security advisor. Rob Field, welcome back to the program.
Joel, good morning. Always good to be on the show. Got some nice topics lined up here.
We do have some nice topics indeed here on Dollars and Cents. We welcome you on into the program that helps you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. Check out all of our information on our website at nelsonfinancialplanning.com. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, co-hosting Rob Field. Well, it's I think someone described it accurately this past week at the office. They referred to it as a bit of an active week.
Active is great. Of course, we're in the middle of tax season. That creates normal cyclical activity, and then the markets have been a little more active than normal.
So active is a nice word for it, yes. With the tariffs and on and off, obviously we've got to get right into that. So Wednesday, obviously the headline-grabbing day, if you will.
Right. So, all this started off with Liberation Day last week, and that the market reacted very dramatically to it. And then on Wednesday, Donald Trump, our president, said, "You know what? I'm going to pause part of these stiff tariffs for 90 days." And the market was hungry for something positive like that. Actually went up. I think we're up 3,000 points. We had an 8% increase in just a few hours on the Dow. S&P was up 9.5%, a little more aggressive, and the Nasdaq was up over 12%. That afternoon. Yeah,
to that point, Rob, from the time that he made the announcement of, hey, we're going to pause it for 90 days, that wasn't just sort of a single day performance. That was like a 3-hour performance that caused the markets to go up that dramatically. That is for sure.
Yeah, so we looked at it was like the largest increase in a 16-year period.
Yeah.
Where we actually had, in just those 3 hours, we saw, from the low of the market to the high. We hadn't seen something like that in 40 years.
Yeah. Yeah, I think, and at the end of the day, that swing, and I saw a chart that noted sort of those swings, or those historical records from sort of the low point and then where it wound up, and it came in fourth overall. What was interesting about sort of the timing, as you looked at the chart and looked at the dates associated with when those big swings happen. I think this was the interesting part of the chart, is that they all seem to occur while you were still in the midst of the crisis itself, right? For example, sort of the biggest swing, so this one on Wednesday came in fourth. The number one was what happened the day after October 19th, 1987, often referred to as Black Monday. That's when sort of the computers wound up sort of taking over the market and sending it way down on that single Monday there in October. What everybody forgets is shows that the next day, that still holds the record, that sort of recovery day, that swing day. And then the other two, number 3, occurred in October, November of 2008. Those were obviously at the peak of the financial crisis there in the fourth quarter of 2008. So some interesting historical perspectives as to when these significant turnaround days, if you will, occurred, right smack in the middle of the crisis itself.
Right. So that data you're sharing, I mean, it underscores the fact that you've just got to be consistent in your investing. And then you got to also understand that the headlines are coming out to be a little dramatic. I know it makes it tough to handle, but you really do have to remain consistent.
You know, we've long said on the program that one of the things that makes market timing the impossible feat that it is that many of the market's very best days are clustered around some of its very worst days, and that's such a concept that I think gets lost on so many people. I mean, think of it this way: you know, you take a single day like Wednesday where the market's basically moved up 10%. That doesn't just have a short-term impact on your portfolio, Rob. I mean, that has longer-term investment performance results impact because of how significant that was. Now, the reality is that just because you have that single day or days, it certainly doesn't mean that the crisis is over, right? No. The Thursday, the markets retreated 3-4%. Friday, they were all over the map as well. So it's not like the crisis disappears, but you have those days in the midst of all of it.
Right, you got to maintain that perspective that, you know, it's the conversations you have, and the market is going to move quick. You've mentioned it before that sometimes there's really 4 or 5 really great days in a market cycle. If you miss a couple of those over time, you're going to end up with a lower average return. And you know, you and I, we had a conversation earlier in the week with a prospect about the exact same thing. We're talking about the highlights and the lack of perspective that especially this client was getting from like the big box financial firms where everything is based on a 1-800 number. He got no support to really walk him through what's been going on lately.
Yeah, well, and what was the worst part of that is, as we were talking to this individual for really the first time ever, I guess they had found us on the internet, and they had made the decision last Friday. And I think we were talking to him on Wednesday, if I remember the schedule correctly. They had talked to him. They had made the decision the Friday before to move all of their IRA, their 401k, all to cash. And obviously Thursday, Friday of last week were big sell-off days. And he certainly had a significant amount in those accounts.
Right. I mean, he felt like he was all alone. Nobody was really walking him through and helping him see the big picture. He ended up moving about $800,000, which, I understand he was concerned, but that was, it's 10% of growth. If we look at that 8% run up we got shortly after he moved, he missed that completely, which, we were talking to him. His goal was, hey, I'm going to need some income pretty soon. And we always talk about a certain percentage of your investment to generate income. That, $80,000 of loss is going to affect his ability to generate income of a certain amount.
Yeah, it's certainly tough to see, tough to hear when people kind of share that. I mean, making those decisions or making decisions at what, is really a very difficult time to do that. You're never going to get that decision right. You're so wrapped up in the emotions and the hysteria of all of it. And sadly, as he shared, he didn't get any guidance on what he should be doing. Sort of in direct contrast to what we did with our clients at Nelson Financial Planning. They all got an email Monday morning giving some historical perspective and some historical comparison based on what we've seen in prior periods of time.
Yeah, we're great about communication. That's one thing I really like, that we are letting people know what is going on. And that email the timing was great. There was such a great perspective in it to be helpful.
Yeah, I think, certainly a significant event, a significant, a headline event, if you will, but not one that necessarily represented significant underlying economic issues that were at play. So we're going to take a break. We come back. We want to just kind of finish this thought in terms of kind of the current situation here in the markets. So stay tuned here on Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning. Rob, as we were talking about in the last segment, an active week of headlines involving tariffs and market reactions to the headlines involving the tariffs.
Right. We've, our listeners have obviously been seeing a lot of information on it. We're following it. We're trying to put out some information to describe how we view it. And again, we keep talking about consistency, and we're hoping that at this point people will really pay attention to the big picture.
Well, and it really underscores, we were talking about this before the break, it really underscores this notion of how difficult it is to think that you're going to kind of be able to market time and get out and wait it out and see how things play out and all of that. If you're an investor and you're selling out on last Friday or selling Monday, lo and behold, out of nowhere comes Wednesday and the tariffs get suspended and the market rallies, depending upon which market index you're looking at, 10, 12% in a single day. And what's interesting about that is that there is a lot of historical precedent for that kind of thing happening, isn't there?
Sure, there really is, because we've talked about this before, that a certain number of days per year can really give you the most of your return over that period of time. And so sometimes the best day, like a day we saw on Wednesday with that huge number, it followed a previous day that had some pretty low numbers. And so you see the market kind of drop. If people get nervous and say, well, I need to get out, that's the time when you're about to see maybe a nice little bump up. If you miss it, it's rough.
Some of the market's very best days are, unfortunately for human psychology and probably your stomach, clustered around some of the market's very worst days. What we saw on Wednesday was the fourth largest swing. In spot number one was the day after Black Monday back in 1987, and then in spots 2 and 3 were days that happened during the course of the financial crisis. I wish I could tell you, our listening audience and everybody else, that at the end of the day, once you get one of those days, then it all passes and everything is sunshine and roses again. Unfortunately, that's not the case. These days happen while the crisis or while the headlines are continuing to unfold, and that's certainly what we saw. I mean, it wasn't like after Wednesday the market just went straight up every other minute after that.
Right. Now, I always tell our listeners and people in the office that we look at the bigger picture. Over multiple years, this market had a run for a couple of years. So if it's up dramatically and then it had a slight pullback, maybe a mini correction, and then the tariffs hit and had another little blip, but then we had that uptick on Wednesday. The numbers aren't always as bad as you seem, but the news media makes it sound like it's...
How quickly we forget that 2023, 2024 were the best back-to-back years in over a quarter century. I mean, it's just quickly forgotten. And so, we believe in providing perspective and informing our clients on a regular basis. We were telling the story of how we talked to somebody for the first time ever this past week who, just wasn't getting any feedback or any guidance or insight into what was going on. And they had pushed all their account to cash a few days earlier, and a pretty significant impact that has. And one of the things we did is we kind of gave some thoughts to our clients on Monday morning of this past week. And Rob, I do think that that this is a headline type of an event that in the email I compared to COVID, I compared to 9/11. I didn't compare it to the dot-com bubble bursting or the financial crisis of 2008. And the reason for that is I draw the distinction that, when you think about 2008, those were significant symptomatic problems in the economy, right? There was a lot of debt outstanding and just too much debt. And so ultimately, that was a systemic economic problem. When you look at 9/11 and kind of what transpired there, you look at COVID, those were all sort of external events, clearly having an economic impact, but not the other way around. And I think that's the distinction. And I put the tariff conversation into that as well. The good news is that, by the time COVID happened, by the end of the year, the market was setting new highs. By the time the year closed in 2001, the Dow was higher than where it was on September the 10th. So that's sort of the perspective and the background that we shared with our clients this week. But boy, it's just so important to just have that overall perspective.
Right. You make a good point. We name all these events, and they did have an effect on the market in the short term, but then every so often the market hits an all-time high. If you just look at, say, well, what has the fund done over the last 15 years? The numbers are very strong. You sometimes forget there was a lot of volatility in between, but those that bought and hold quality were rewarded.
Yeah, and Rob, that's a very good point. You got to have a well-balanced portfolio. You got to have a well-diversified portfolio. I mean, that's always core, right? Any of our comments that we've ever made on this show sort of assume that in the background, right? Because it doesn't work if got a concentrated portfolio, or if you've got a portfolio that's all in just the same types of stock. So, that's where we will often talk about one of the things that we do for folks when they first come into the office is we kind of run that analysis. We run a report that really looks behind the curtain at what it is that you actually own, and where you own things. What type of sectors? What's the concentration? All of those kinds of things are part of those conversations that we have at the office.
Right. I like that report because it'll take individual investments, mutual funds, insurance-related products, and just give you one large summary, which is really at times you want to know, how is everything working together. It's a great report.
No, absolutely. So for those that are listening that maybe don't have that perspective or insight into their individual portfolios, we encourage you to visit our website at nelsonfinancialplanning.com. There you can ask for one of our absolutely free consultations where we will, as always, kind of run that analysis and let you see what it is that you actually own across the board in your investment portfolio. So, let's shift some gears, Rob, and talk a little bit about Social Security, particularly this Windfall Elimination Provision. Tell us a little bit about what this is and kind of where it came from, because all of this has now changed dramatically.
Correct. So the Windfall Elimination Provision, it's kind of addressing people that worked for a government job and then may have also had an outside job, and so they're going to get a pension at retirement from the government job, and then they also qualify for a Social Security benefit. And so Social Security was trying to make sure they weren't doubling up. So, back in, I guess it was 1983, they decided to put in this provision that said, okay, if you're getting a pension from the government, we're going to have it offset the amount of money we send you for Social Security. The goal was somebody who worked just for a job and fully had Social Security being the money that was put in for their benefit, somebody shouldn't get that full benefit and a windfall per se from getting a government pension. But they called it the Windfall Elimination Provision because that's what they were trying to do, and they just didn't want anybody to get anything that was extra. The great news is what's bringing us to where we are today is that that's been eliminated by that Social Security Fairness Act. That was passed in January of 2025, and the whole thought was we really shouldn't be penalizing these policemen, these officers who have been working, and they're going to get them back up so that they won't have that elimination. And they're doing a couple things. They're going to increase your payment back up to where it should be, and they're going to go back retro for the last year, give you a lump sum payment to kind of catch you up to what you should have had all this time.
Well, and those letters certainly have been going out. My mom got one,
Right.
And so I thought it would be a good topic to talk a little bit about the concept behind that Windfall Elimination Provision and what its impact is. So we're going to continue that piece of the conversation after we return here on Dollars and Cents with Joel Garris and Rob Field. So, Rob, we're talking about this windfall elimination provision and what effectively has been the elimination of the windfall elimination provision. So, on a historical basis, that windfall elimination provision, Rob, related to people that had worked government jobs, right?
Right.
They were going to get a pension from the government job, but they also had worked some in the private sector as well along the way. And so they were also going to pick up a Social Security check as a result of that additional employment. And, obviously the thought going back to 1983 when they introduced this windfall elimination provision is, well, wait a minute, we don't want those people to sort of double dip, if you will.
Right, exactly. And so that provision was trying to prevent that. And then over time, and this is obviously exciting for people who had that type of position, they've stopped that. That Social Security Fairness Act has basically said we're eliminating that provision. So now whatever you get from your pension from the government job is not going to reduce how much your Social Security benefit would be. They've let the people know, and we'll look at an example, that your benefit is going to go up. And so they sent out a letter that basically said, we're going to correct this. Your benefit is going up because we're going to drop that provision. And in the same letter, they said, oh, by the way, there was also cost of living adjustment.
Right.
So you get a little bump up there. And not only that, but we owe you some back pay. We're going to send you a lump sum check. They went out in March. I'm getting calls from people like, hey, I got my little
Right.
Social Security
Right.
bonus. So,
Right.
It's nice when, I like to talk about Social Security. I'm positive and upbeat about what it can do. It is nice when they do something that people are like, hey, look, Social Security's doing well. They're not having trouble.
Lump sum, they lump summed it back the full amount retro back to January of 2024, so a full year. I mean, at the end of the day, this provision impacted about 3% of those that were receiving Social Security. How it worked, or the mechanism, is that it would modify the primary insurance amount, which is obviously the base amount of Social Security that somebody receives, and so they would reduce that initial percentage used in that calculation, and then the amount varied based on how many years a person had worked in Social Security covered employment. It couldn't reduce Social Security down to zero, but it could certainly significantly reduce it. And the example that we're going to share is actually the example of my mother,
Right.
who was a public school teacher for 25 years, retired from the state of Maine, was getting a Maine pension, and she also worked part-time for many, many years when she was still working as a teacher, and then after she retired, a place called LL Bean. If you're familiar with Maine, you know that LL Bean is the big, big store, big clothing store up there. So she worked a number of years there, and be just a perfect example of how that windfall elimination provision worked, because of the virtue of the fact that she had a public pension from the state of Maine, her Social Security was reduced.
Right. And then thanks to this, the provision being dropped, it was back up to where it should be. And then, and we have a copy of her letter. They reminded her your benefit's going up, and it's also going to go up a little bit more because of the cost of living adjustment. And then they told her what the new numbers would be. Then they said, and by the way, got a lump sum coming your way in the month of March.
I looked at it. Now my mom is in assisted living, so every dollar counts. Assisted living, obviously not cheap, and but yeah. So her Social Security went from Rob. I was shocked at the numbers. She was getting $317 of Social Security. Now, obviously, she wasn't getting all of that because Medicare and all the
right.
Medicare
The Part V
Advantage,
premium comes
was,
out.
was coming out, but her gross amount was $317. Okay, I know that because I actually looked it up on our tax documents.
Sure.
And they bumped her all the way up to $740. It like over doubled in terms of what she was getting.
And you probably noticed they bumped it to $740 for what it should be without the provision, and then they said, oh, by the way, it's also going up to $759 because you got a cost of living adjustment.
Right. No, I mean that's So from $317 to $759, you're right, because the COLA, the $740 was what was the 24 number, and then with the COLA, it was $7. So $317 to $759.
Right.
And then an extra $5,800.
And then they sent her an extra $5,800 lump sum.
By the way, that's a month in assisted living. So
right.
That's not, that was nice to see that.
And it's corrected. Going forward, it will continue. It's not like, hey,
correct.
we did this for a year. The lump sum got you caught up. Going forward, it's the new higher amount because the provision has been dropped.
And you know what I'm going to say next, Rob? The thing that concerns me is where did they find the money to pay for this?
Yeah, I know. I hear that all the time. Because out of one hand, they're saying, based on the amount of money we're bringing in, if nothing changes, then come 2034, we'd have to reduce benefits.
But yet we just started paying a bunch of people more money. Yeah, I guess. Because it was my mom, I didn't object too much. Yeah, I guess.
I'm happy today, and I'll push the.
Our poor grandkids, they're not going to get anything for Social Security.
I always remind people that Social Security makes their money by taxing our income, and they increase that every year. And then they're also trying to push and motivate people to retire later because they're only on the hook while you're alive. Social Security doesn't pay, isn't like your 401k where you can pass it on to the next person. So if they keep increasing how much they're taxing and they keep encouraging you to retire later, it'll help.
Yeah, correct. Still, though, I think average life expectancy since the last change to Social Security, which is the 1983 average life expectancy, has increased by 11 years. So that gives you some perspective as to kind of what might need to happen in terms of some changes. But one of the biggest changes that I think is impacting or could potentially impact people, we talked about the Windfall Elimination Provision, but what about the taxation of Social Security? Obviously, this is tax season is concluding, and my goodness, we just see it all the time. The number of people that are having to pay tax on their Social Security just keeps growing and growing and growing.
Right. It's a lot of people don't understand how taxation works with Social Security, so we were going to kind of blow through a list of 7 things you might want to kind of put in the back of your mind when it comes to Social Security because, they are taxable. I mean, it can be taxable based on a couple different things, and that subject comes up a lot. Social Security came out in 1933, wasn't taxable at all. And then 1983, they decided they would start taxing those benefits. What we've noticed is that they continue to tax. People don't really understand how or what they can do to address it. We always remind people for the taxation part, it's based on your income, not your age. Right. Social Security has a variety of things where they do their calculations based on income. Some calculations are based on age, full retirement age, that's based on your age. How much you get at full retirement age would depend on what your income was. We talk about the earnings limit. That's a combination of how old are you versus what is your full retirement age versus your income or how much money you're making. But for Social Security taxation, it is just your age. And so what they do is there's a kind of I think it's a convoluted formula that hasn't changed in quite a while, but it's all based on your combined income to decide how much of your Social Security might actually be taxable. And so the formula is basically take your adjusted gross income, throw back in any tax-exempt income you had, toss in any foreign income that you might have had, and then add in 50% of what your Social Security benefit was. All that tells you is a number that's called the combined income. From there, there's some thresholds that tell you, based on the amount of that combined income, how much of your Social Security is taxable. Not how much you'll pay, but just how much of it would be included. So we know that if you're married and you're filing jointly $32,000 or less, you would not have to pay taxes on any of your Social Security. Other taxes, yes, not on Social Security. Between $32,044, they could add in up to 50% of your Social Security as income that could be taxed, and above the 44 number, up to 85% of your Social Security could be taxed. Now, the thing to keep in mind is that you're not going to pay 85% taxes on your Social Security.
Right. The tax rates aren't quite that high.
Right. Yep. Luckily, I mean, give us a few more shows. We don't know. See how this tax season goes.
But here's the thing about that. Really, at the end of the day, Rob, the more income you have. So what you see is that where you have a higher level of income, folks then wind up having to pay more taxes on their Social Security as a result of that inclusion ratio. So we're going to talk a little bit more about this when we return here on Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning. So on the program, we were talking a little bit about Social Security and the taxation of Social Security, Rob. And, as we roll through tax season at Nelson Financial Planning, where if you are a client of the firm, we do offer actual tax preparation services. That's one of the things I think that makes us relatively unique in the Central Florida area, that when we talk about having a tax-efficient retirement plan, we actually run the numbers very specifically to make sure that said retirement income plan is as tax-efficient as possible. No better way to do it than an actual tax return. And I will tell you, Rob, this conversation about Social Security is a good reason why you actually need to run a tax return, because it's a complicated formula that determines that, as you were talking about on the last segment. It is.
You're talking about one of the great beauties that we can also provide tax services. We're big into coordination. We know that we're talking and kind of laughing about Social Security. You can't count on that to be 100% of your income, and so we want to help coordinate Social Security with your investments. And then with your investments, tax issues come up. It's nice if in-house you've got a group that can look at the investments as well as the tax side and give you advice and then coordinate it all. It's something we provide that very few people do.
Well, and certainly the calculation, as you were describing, so you got to look at the amount of income that you are making when you're trying to figure out. And it's not to the point that you were making. It doesn't require you to pay tax per se on Social Security. It just is the amount of the Social Security that then gets included into your adjusted gross income, that then from there the calculation spins off to determine how much it is that you owe on your tax bill. And just a little bit extra income, we often see where you can often have just a little bit extra income and almost trigger a dollar for dollar increase in the amount of taxation that you have to pay on your Social Security.
Right. And so when we were running those numbers, we were, one of the things to remember about the taxation on Social Security is that you're not going to be taxed on all of your benefits. It's just going to be the formula we talked about, combined income, to come into play to tell you how much of the Social Security will then be shifted over and added to other things that you might be paying taxes on. So the maximum amount of Social Security you would pay taxes on would be 85%, but you're not going to pay an 85% tax bill on your Social Security. That actual amount is going to be, as when we work with our clients, we're going to say, okay, here's combined income, here's everything else. We've come up with this number. This much of Social Security is going to be added as income to be taxed. From then on, it's your tax bracket.
Sure. No, that's exactly right. I mean, the good news is that at least 15%, no matter how much income you make, at least 15% of your Social Security will be excluded from your income. You won't have to pay taxes on that. But Rob, I've so many scenarios where we just think, look, last year there was higher interest. So if you had money in savings, you made more interest last year than you have for many years. There were a number of returns where someone had an increase in interest earned on their tax return of maybe an extra $4,000, and I'll be darned, there's the taxable amount or the amount of the Social Security that then was included in income increased by $4,000 as well, dollar for dollar. So right. the extra amount of interest that they made, the effective tax rate was double as a result of that.
Right. A lot of people don't know that you can actually withhold taxes from your Social Security. That's the next thing we're going to talk a little bit about. Sometimes some of our investors, like if you have an IRA, it's easy to withhold. But if you have a non-IRA, a brokerage account, you're not really withholding on every one of your transactions. You kind of have to do it at the end. So what we find out is a way to offset that is you can withhold different amounts on your Social Security to kind of help over the overall picture. A lot of times when you sign up for Social Security, they don't allow you at that very moment to pick the tax withholding. So then you got to go back and get an IRS form W-4V, which is a voluntary tax withholding form for Social Security. And then even then, you're limited to only 4 options. You can either withhold 7%, 10%, 12%, or 22%. And so if our client's income is strong, we're like, withhold 22%, you've got other money coming in, and then at the end of the year, you won't have as much of a tax burden because you've kind of done some prepay.
It is odd that they only give you those 4 specific amounts, which have no relativity to the actual. I mean,
Right.
I
It's
guess
not.
they're
It's
based
not
on
related
the
to tax
margin.
bracket.
Yeah,
It's
yeah.
just around, and those numbers have been the same for quite a while.
Correct. Long before the tax brackets actually became the 10, the 12, and the 22. And so certainly I found myself, recommending to a lot of folks this past tax season, well, you probably want to do some tax withholding on the Social Security.
Right.
And I guess that's a fascinating thing. One of the fascinating conversations that's happening in Washington is that the conversation about the taxation of Social Security is starting to get at least some conversation, and we haven't heard anything about that for decades now.
No, but that windfall elimination provision eliminated, it's a great way of saying, okay, look, they are looking at ways to help out, because I've pointed this out numerous times. There are people who, 90% of their income comes from Social Security. There's a large number of Americans, and we also do not want to decrease the amount of money that they get. So if you could say, well, by reducing taxes or eliminating taxes on Social Security, because the argument I always hear is, well, I paid taxes all my life on my income, and you taxed me to fund Social Security. Now when you're giving me the Social Security, I now have to pay taxes on it again.
Right.
It doesn't make sense, and obviously, if somebody is having to pay 12, 15%, if you could reduce that, that helps their income. So
it'll be an interesting part of the conversation. Obviously, next up over the next few months, I think the House managed to get the budget framework or the tax framework through last week. So I think we'll be shifting some gears over the next 2 or 3 months, talking a lot more about tax policy. But this one really is an interesting one because we just see it day in, day out. The number of people that are getting impacted by this, the number of people that if you have a little bit more income and then you have a dollar for dollar increase in the amount of your Social Security that gets included in your taxes. So to your point, Rob, I've found myself recommending to a lot of folks this year, hey, you probably want to go back in and, to your point, do that W-4V form and get some tax withholding done on your Social Security.
Right. It's very easy. It's a form you can download at ssa.gov. It comes printed. You just simply check the box of how much tax you want. You send it into your local Social Security office. Not like you have to upload it or provide any kind of supporting documents. So it's very easy to do tax withholding from Social Security.
Yeah. Yeah.
The other thing I always like to point out is that, the taxes that we do pay, even if we didn't want to, they go back into the Social Security system. They actually help fund Social Security benefits and Medicare benefits. In 2023, the amount of taxes they collected by taxing Social Security was over $50 billion. So it does help. I mean, you might not like paying it, but it's not going to be a waste. It does help strengthen up the trust fund for future benefits.
Well, and the key thing to remember also is that when you talk about Social Security and putting that on your tax return and having it included in your income, it doesn't matter the type of Social Security that you're getting. I mean, it can be retirement or disability or survivor benefit. I mean,
correct.
All of that is Social Security, and none of that is some special, hey, I don't have to include this. It's all counted as the same.
Right, that's exactly right. The only thing that gets away with it is the supplemental security income, which is like benefits for people with low income or very weak financial assets. They don't pay taxes on that, but you're correct on everything else. It's taxable.
Yeah. Pretty significant. And then to your point, good news is we live here in Florida, so we don't have to worry about this last one. But
correct. Some states do also tax your Social Security. So, we do live in Florida. We don't have state tax, so we avoid it.
We're not going to name names. So
no.
So, but just if you're in a different state, make sure, or you move into a different state, make sure you research these issues.
Right. Your accountant will let you know. And then the last thing I'd like to point out is that the cost of living adjustment can impact your taxes.
Sure.
We talked about those thresholds. So if the amount of money you get from Social Security goes up, and a percent of that income can be used to calculate how much you owe in taxes, you got to keep that in mind. Those thresholds those are low numbers, like 44,000.
No,
If you're above
everybody gets stripped on
44,
them.
you're already up to having 85% of your Social Security is paid.
And that, I think, where you'll see the change. I think these thresholds will change. And
Right.
hopefully that means that for more Americans, then you'll go back to not having to pay tax, or maybe not having to pay as much tax on your Social Security.
Right.
As they say in radio all the time, stay tuned, because we will have much more to talk about on this and many other topics as we do each and every week here on Dollars and Cents with Joel Garris and Rob Field. Check out our website, nelsonfinancialplanning.com, to see how we might be able to help you this coming week.